Welcome to the Deep Dive. We're here to cut through the noise and get you informed quickly. Today, we're doing a deep dive into an investment case. Investing in Enbridge for reliable dividends. Our mission really is to unpack why this energy giant, Enbridge, is seen as such a solid holding for dividend investors. We're drawing on an article that gives 10 specific reasons. So for you, the listener, the idea is you get a quick but still thorough grasp of this specific investment case. And honestly, we might uncover some surprising things about how stability gets built in, well, a pretty volatile sector like energy. Okay, let's jump right in. The first thing that grabs you is Enbridge's dividend yield, 5.8%. That number, it definitely stands out. How does that really stack up? I mean, compared to market averages. You look at the S&P 500, it's yielding, what, maybe 1.2%? And the average energy stock is maybe 3.3%. So
Yeah, it's a great point, and that yield is definitely attractive. But what's really fascinating here is it's not just the yield number. The dividend history is critical when you're talking reliability. And Enbridge has this really impressive record. We're talking 30 consecutive years of dividend. It really underscores a proven reliability. It goes way beyond just a snapshot of today's yield. It shows real financial discipline over time.
Okay, 30 years. That's quite a track record. But what about the financial foundation itself? Beyond just the payout history, is the company fundamentally strong enough to keep that going?
That's absolutely crucial. And yes, Enbridge holds an investment-grade credit rating. For a company in this sector, which needs a lot of capital, that's quite significant. It means they have a strong financial base. And practically speaking, it gives them access to cheaper capital, cheaper debt. That makes funding projects easier and, importantly, helps secure those future dividend payments more effectively than maybe some of their peers.
Right, so the financial bedrock seems pretty solid. But here's the part I find really interesting. How does a company that's so tied to the energy sector, which, let's face it, can be incredibly turbulent, manage to generate such sort of predictable returns? The article calls their business highly reliable and boring. That almost sounds like a contradiction in energy. How does that work?
Yeah, it does sound a bit strange at first glance, but it makes sense when you look at how they make money. Enbridge's core business isn't really about speculating on the price of oil or natural gas. They own the actual infrastructure. Think pipelines, storage facilities, terminals, the assets that physically move the energy.
Oh, great.
So they operate more like a utility. They charge fees for using these assets. It's largely based on contracts, these fee-based arrangements. And that generates really stable income because the demand to move energy stays pretty strong, regardless of whether oil is $50 or $100 a barrel.
Okay, so it's like a toll road for energy. People pay to use it no matter the value of the cargo.
Exactly. That's a great analogy.
And they are massive in this space, right? Something like a $100 billion market cap, one of the biggest midstream players in North America.
Huge. Absolutely one of the giants.
How does that sheer scale help them strategically, beyond just being big?
Well, that size gives them significant strategic leverage. Their scale, combined with that financial strength we talked about, it means they're in a powerful position to consolidate the market. They can acquire smaller players to enhance their network or expand into related businesses.
Makes sense.
And it's not just about getting bigger. It's often about optimizing the whole system, making it more efficient.
Okay, that covers the external growth, buying things. What about growing from within? Do they just rely on acquisitions, or is there an internal growth engine too?
Oh, absolutely. They have plenty of internal levers to pull, as the article puts it. A big part of their strategy is ongoing capital investment. They're always looking to upgrade their existing pipelines and facilities, expand capacity. And what's quite smart is when they do acquire an asset, they often look for opportunities where they can add even more value over time, maybe by investing additional capital to fix bottlenecks or boost how much can flow through.
So they buy something and then invest more to make it even better.
Precisely. They might buy an asset for a certain price, but they see potential to significantly increase its long-term earnings with targeted upgrades. It creates this virtuous ongoing cycle of growth. Pretty effective.
That internal value add strategy, even after buying something, that definitely shows some smart long-term thinking. But looking at the bigger picture, we all know the energy world is changing, shifting. How is Enbridge positioning itself for that, for the evolving energy landscape?
Yeah, they seem to be very aware of that. They're making a clear strategic shift towards natural gas and other cleaner energy sources. They know the world is moving. A really key example is their recent deal to buy 3 regulated natural gas utilities from Dominion Energy.
Natural gas utilities.
Right. These aren't just stable cash flow businesses, though they are that. They're strategic. It aligns them more closely with the growing role of natural gas, often seen as a bridge fuel in the energy transition. So this move kind of de-risks their future portfolio a bit and also shores up their growth prospects, making those future dividend hikes seem, more likely.
And what about pure renewables? Are they dipping their toes into wind and solar, or is that still off in the distance for them?
No, they're definitely involved. They have what the article calls a modest exposure to renewable power, but it's significant. They've actually been investing in clean energy for quite a while, so they understand the space. They own stakes in large offshore wind farms in Europe, for instance, plus other renewable assets.
Offshore wind in Europe, interesting.
Yeah. So while it's not, the main driver of their revenue today, it's framed as this proactive toehold. It prepares them for a future where clean energy is a much bigger piece of the pie. The expectation is that this part of their business will grow, probably slowly but steadily over time, basically mirroring what's happening globally.
Okay, that paints a pretty clear picture of the business and strategy. Let's bring it back to the practical side for you, the investor. What does all this actually mean if you're thinking about owning Enbridge shares? How does it compare to other ways you might invest in this kind of energy infrastructure?
Well, one big practical point is how Enbridge is structured. It's a traditional corporation. That generally makes it easier, quote unquote, to own compared to, say, master limited partnerships or MLPs. You might know names like Enterprise Products Partners.
Easier how? Taxes.
Exactly. With MLPs, you typically get a complex K-1 tax form each year. It deals with partnership income, depreciation, things like that. It can be a headache for some investors. Enbridge, being a corporation, sends you a simpler 1099 DIV form. For many people, that just makes tax time a lot smoother.
That's definitely a potential plus for simplicity. Good point. But there is that nuance. Enbridge is Canadian. What about that for U.S. shareholders? Are there tax things to watch out for?
Yes, there are. Good catch. Because it's a Canadian company, dividends paid to U.S. shareholders are typically subject to Canadian withholding tax.
Okay, so you lose some of the dividend to Canadian taxes.
Potentially, yes. However, there's a tax treaty between Canada and the U.S. And the good news is this treaty allows U.S. investors to often avoid that Canadian tax if, and this is the key part, if you hold the shares in a tax-advantaged account.
Like an IRA, a Roth IRA.
Precisely, like a Roth or traditional IRA. If you hold Enbridge there, you can usually file a form with your broker, typically a W-8B Ben form, to claim the treaty benefit and eliminate that Canadian withholding tax.
Okay, so a bit of paperwork with the broker, but potentially worth it to keep the full dividend in those accounts.
Right. Definitely something to look into with your specific broker. And one other related point, because it's Canadian, the dividend you receive in U.S. dollars will fluctuate a bit.
Currency exchange rates.
Yeah, the KDSD exchange rate will impact the exact amount you get each quarter. That rate can move based on various things, like interest rate differences between the U.S. and Canada. Just something to be aware of.
Got it. So a little tax planning helps. And keep an eye on the currency aspect. Overall, though, the article we've been discussing seems pretty positive. It says Enbridge checks almost all the boxes, even while acknowledging, that no investment is truly perfect. So just to wrap things up, we've seen Enbridge offers this interesting combination. You've got that high dividend yield, but it's backed by a really long history of reliability. Then there's the business model itself, focused on that essential, almost utility-like infrastructure, which gives it stability. And on top of that, a forward-looking strategy that seems to be embracing the shift towards cleaner energy. It really is a compelling case study, I think, in how a company can try to build stability and value in what seems like a pretty shaky industry sometimes.
It really is. And maybe this leaves you with an interesting question to think about. Enbridge's stated long-term strategy is basically to provide the energy the world needs, no matter what form that energy takes.
Okay.
So considering that kind of diversified infrastructure-first approach, what might that mean for other, maybe more traditional energy companies as they try to navigate this global energy transition? How important might it be for them to adapt by building these broad asset portfolios instead of maybe just sticking solely to legacy fuels? Could that be the key to future stability in this changing world? Something to mull over.
Yeah,